Every time you buy or sell a stock, you are making a bet. You are essentially betting that you are smarter than the person you're buying from and cleverer than the one you're selling to. But in a massive $70 trillion market, do you actually know who is on the other side of that trade? Today, we're pulling back the curtain on your competition, from the top 1% who own a third of the market to the gamblers creating the next bubble. If you want to understand your own approach, you first have to understand theirs. Just a note before we start. This video is for educational purposes only and is not financial advice. All investing involves risk, so always consult a professional before making investment decisions, as we cannot take liability for any financial losses.
We often hear phrases like, the market is up, or investors are worried. But the market isn't just one big group. It's a segmented mix of people acting in very different ways. In 2026, about 62% of American adults, roughly 165 million people, own some shares. However, the pie is anything but equal. The top 1%, those with at least $14 million in assets, own about one-third of all stocks. The next 10%, people with $2 million or more, own about half of the market. The rest, or 89% of the population combined, own only about 10–15% of shares.
It's not just individuals with brokerage accounts. The way these shares are held matters. Direct ownership accounts for 38%. Bundles like ETFs and index funds account for 25% of the market. Big institutions like banks hold 20%. Foreign investors own 18%. The landscape is changing fast. Commission-free apps have brought in a wave of new investors who tend to buy and sell quickly, unlike big institutions that hold for the long haul.
Furthermore, the market has become incredibly concentrated. Just 7 tech giants, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, now account for nearly one-third of the entire S&P 500's value. Stock ownership is still heavily tied to how much you earn. In 2026, 87% of families earning over $100,000 are investors, while only 28% of those earning under $50,000 participate. This creates a cycle where government decisions, like tax cuts for the wealthy, often flow straight into the market, pushing prices up and potentially widening the wealth gap. To understand why prices actually move, we have to look past ownership and look at behavior. We can segment investors into 4 primary archetypes. Smart money. These are professionals and institutions that set long-term valuation trends. Slow money are buy-and-hold investors who provide market stability and liquidity. Quick money is active traders who drive daily price swings based on perceived risk. Finally, gamblers. These are usually uninformed traders taking big leveraged bets that can make prices jump up and down day to day. So, in conclusion, the majority of the shares are held semi-independently by individuals making their own choices, while the rest are held by people managing others' money. We believe that this is an important distinction. It gives an emotional element to investment decisions, as people can never be 100% logical when investing their own money.
Does this demystify your competition now? Instead of thinking about the market, think about all those doctors and lawyers making buy and sell decisions. Think about the trading desks of banks and also the gamblers using their phones for online trading. Now let's bring in our peer reviewer, Pete, for his opinion on our video.
Thanks. I have a few minor criticisms of your video. First, remember that total ownership doesn't move prices. Prices are driven by active traders. For example, the Nasdaq sees about 6 million trades a day, which is only a tiny fraction of the total shares out there. These active players dictate the short-term price. Also, you should group people by how they act, not just how much money they have. Behavior is what really moves the needle. Finally, keep in mind these numbers are just estimates. It's actually quite easy for big players to hide exactly how much they own.
Thank you, Pete, for your insights. I would just like to add that, as always, this discussion is intended for informational purposes and should not be regarded as investment advice. We've summarized this entire 30-video series into a book available now on Amazon via the link in the description. The book, or e-book, covers these issues in much greater depth than a single video can allow. After you grab the book, I recommend checking out our next 2 sessions linked on your screen. These are on the 2000 and 2008 market cycles, so you can see exactly how these patterns played out in real time. Thanks for watching, subscribe for more, and I'll see you in the next deep dive.